Hi there, folks, and welcome to Livewire Markets. My name's James Marley. I'm a co-founder of Livewire, and I'm joined today by Christopher Joye, who's the Chief Investment Officer of Coolabah Capital Investments. Chris, thanks for coming in.
Thank you for having me, James.
No worries. Now, today in this Fund in Focus session, we're going to be speaking to Chris about his views on developments domestically and globally at the economic level and some of the opportunities that he's seeing across fixed income markets. We're also going to be learning a bit about a couple of Coolabah strategies. We're going to be learning about the Coolabah Active Composite Bond Fund, and we'll also be learning about the Coolabah Active Global Bond Fund. But Chris, before we learn about the funds themselves, as we look out to 2025, what are the key trends that are influencing your views on the Aussie economy and how they relate to fixed income markets?
Yeah, well, we're very focused on fiscal dominance. Politicians are spending crazy amounts of money. In Queensland, they've spent $1.5 billion to give away free school lunches, and we're seeing enormous budget deficits locally and globally. So politicians are priming inflation at the same time as monetary policy is trying to compress inflation. Since World War II, the Fed's delivered 13 recessions and 3 soft landings, but 2 of the soft landings ended up in recessions. So we're really talking about many recessions and one exception, a really rare exception, which was in the mid-1990s, where they only cut rates by 75 basis points in that one soft landing. And that was because wage growth was weak, because we had a huge recession a few years prior. And we also had China exporting deflation. So I think we're exercised about the risk of a higher for longer environment, about the risk of an acceleration of inflation next year and the year after. And I think it's sobering that with the Fed cutting by 50 in September, we've already seen a batch of, for the market, surprisingly strong inflation, wage, and jobs data. So the US unemployment rate fell from 4.25 to 4.05%, and we had very strong wage growth. Then we had very strong inflation data, or stronger than the market anticipated. And here today, the day we're recording this, we got news of very strong jobs data in Australia. So the unemployment rate actually fell. Wrapping all this together, I think that investors need to be focused on the risk of any sectors that are cyclically or interest rate sensitive. So the periphery of the economy. Every day we're opening up the Financial Review or newspapers and you're reading about war stories in private debt, lenders getting smashed, defaults and delinquencies. And this is a global phenomenon. We've heard of some of the biggest private credit managers globally having 40 to 50% of their portfolio that is delinquent or in stress. And I think this is going to be a multi-year battle. So you want to be liquid, you want to be up the capital structure, you want to be defensive, and you want to have the optionality to pounce on dislocation when it emerges. But the message in response to your question is really about challenging this notion that we'll get this straight line mean reversion in inflation back to 2%. We would acknowledge that's plausible and possible, but it's heroic, and we think it's going to be a much tougher multi-year battle.
Over recent years, and as recent as this year, you've been a strong advocate for a bias towards investing short in floating and short duration fixed income. Is that still the view?
Well, that's certainly paid massive dividends. If you look at our 2 core floating rate strategies, our most popular products, that's our floating rate high yield fund, which is A+ rated, fully floating, and it pays a yield of 7.7%. In the last year, that's returned 10% after fees. Our second most popular floating rate strategy, our long short credit fund, in the last year, I think has done around 10.5% to 11% after fees, and it's currently yielding around 7 to 7.5%. So those strategies have done brilliantly, and being floating since 2021 was definitely the best place to be, because fixed rate bonds got smashed as interest rates rose, their prices fell. Having said that, we've advocated having a quarter to a third of your portfolio in fixed rate or long duration strategies. So in fixed rate bonds rather than floating rate bonds. Now these are debt instruments that profit from interest rates falling. As interest rates fall, fixed rate bond prices rise. And in our market leading fixed rate bond strategy, we've done about 10.8% or 3.7% over the benchmark. We'll talk about this later. But duration, and I don't want to use too many technical terms, but fixed rate bonds have just started to deliver after years of pain as yields rose and bond prices fall. So to answer your question directly, this is a moving feast because your appetite for fixed rate as opposed to floating rate really depends on where long-term interest rates are. Now, a month ago, they were very unattractive. In fact, I exited personally all my fixed rate bond exposures in our funds. And that was when the US 10-year government bond yield had fallen all the way down to about 3.6%. But it's bounced up. This was in September. It's bounced up to around 4% on the back of the strong inflation and strong jobs data. And of course, remember, we've got a very important US election. And if Trump wins, which is what the bookies say will happen, I have no idea who's going to win personally. But if Trump wins, all the evidence suggests that inflation will be much higher and bond yields will be higher under Trump. So I think you will get some really, really attractive entry points to buy fixed rate bonds and switch from floating. And what that really means is it's like locking in your yields. It's like you're taking out a 5-year term deposit. So I'm kind of hoping Trump wins. We get a pop in yields, and then personally, I'll be jumping back into duration.
Let's chat about a couple of the Coolabah strategies that are available. The Coolabah Active Composite Bond Fund. Tell us about the strategy. What's its objective?
Yeah, so we launched this in 2017. Since that time, it's beaten every long duration product in the market. So it's benchmarked against the major index, which is called the Composite Bond Index. And that is a fixed rate bond index. And the average duration is about 5 years. So the Active Composite Bond Fund always gives you that same 5-year fixed rate exposure as the index. So we have 5 years duration. We add value through trading. So we're the most active trader of Aussie bonds globally. We buy and sell $500 million to $1 billion a day. In the last 9 months, we've traded about $110 billion. And we have the biggest team in the market. So I have 47 professionals working for me, 11 traders, 15 analysts in London, Sydney, Melbourne, Auckland, and shortly Miami. And what we do is we use 80 different bond pricing models globally that we've built in-house to find bonds that are paying too much yield for their risk. So ideally we buy a CBA bond paying 6.25%, that's mispriced, that should only pay 6%. And as that interest rate approaches our target, we get price appreciation. So we're a very active manager of global bonds. And in fact, I think I can disclose that we actually recently won a US $1.1 billion mandate from one of the biggest global investors who replaced a brand name, a fixed income house. I can't name who they were specifically, but in their global core, it's called a global aggregate corporate strategy. Coolabah has replaced that brand name manager, which is really a household name. And that was because in the global aggregate universe, as it's known, we're about to talk about this universe in a second, they said we were the best performing manager in the space. So coming back to the composite bond index strategy, the Active Composite Bond Fund, it's available on platforms as an unlisted product. It's also available as an ETF. The ticker is FIXD. We've had a lot of retail flows into the product. In the last 12 months, it's returned 10.8%. The index has done 7.1%. Now you might ask, well, how are we getting almost 4% after fees above the index? It's from that active trading. We actually have very similar volatility to the index. So our volatility historically has been about 0.2% higher than the index, very similar. Our volatility is very similar to the peer universe. When the index has a negative month, we actually beat the index 80% of the time. And typically the median excess return in a negative month is 0.17% or 17 basis points. When the index has a positive month, we beat that index 70% of the time. So we actually do better when the index does worse. But overall, the goal, which was your original question, is to beat the index by 1 to 2% per annum. And that's absolutely what we've done. And we rank number one on our numbers over 1 year, 3 year, 5 years, and since inception. So if you want duration, which is a really interesting form of insurance to have in a portfolio, if you think we're going to go into a recession eventually, or if you think interest rates will come down eventually, what 5 years duration basically means is that for every 1% fall in interest rates, you should earn a 5% return. So if the RBA ever cuts rates aggressively from 4.35 back down to 2.25, or heaven forbid, all the way back down to 0.1, which is where they were in 2021, then duration is going to give you spectacular returns. So that's why people think of duration as a hedge against adverse scenarios. And the active composite bond fund is, in our view, the leading solution in that space. And it's very liquid, it's A+ rated.
We're going to talk about a global strategy in a moment, but just first of all, could I get you to talk through your view on the global scene versus the domestic scene, particularly with how it relates to fixed income markets and opportunities?
Yeah, that's actually a really interesting question. So the RBA is in a very different situation to the rest of the world. Our inflation is much higher than the rest of the world. Our economy is generally much stronger, and that's because interest rates in here never really went as high to the circa 5 to 6% levels that we saw in the US, England, or Britain, Canada, and New Zealand. The RBA is tolerating higher inflation. And the jobs data that came out today, where the unemployment rate actually fell here in Australia from 4.2 to 4.1, all of that suggests that the RBA is not cutting rates anytime soon. So on the one hand, the RBA is on hold for the foreseeable future. On the other hand, the Fed cut by 50 in September. It'll be interesting to see how the Fed reacts to all of this very strong US economic data that's suddenly materializing. But the Fed had planned on cutting by at least 100 basis points in total this year. The ECB's cutting, the Bank of England's cutting, the New Zealanders are slashing rates aggressively because they're up at 5.5% and their economy is in recession, and the Canadians have been cutting. So it is a very different situation here. We are on the cusp of seeing a scenario where interest rates in Australia could suddenly look quite attractive compared to the rest of the world. If those offshore central banks keep cutting, Aussie yields will look relatively quite attractive. For quite a number of years now, Aussie yields haven't been that attractive. I would say the other interesting development here in Australia in the last 6 or so months, or maybe a little bit longer than that, has been that the extra spread or interest rate margin that you earn on Aussie credit, so Aussie bank bonds, insurer bonds, and corporate bonds, that extra credit spread has actually been quite attractive by global standards. So Aussie credit is where we've had most of our portfolio, having been very globally diversified 1 to 2 years ago. And that's because US spreads and Euro spreads didn't look that attractive. The flip side of that coin, and where Australia is not as attractive, so on the one hand, we've got potentially quite attractive cash rates if the RBA rate stays the same and the rest of the world's cutting. On the other hand, our spreads have been pretty good compared to the rest of the world. Where the local market isn't necessarily as attractive is in what we call the new issue market or the primary market, which is like the IPO market for bonds. So we're seeing 10, 20, 30 plus new deals globally a day, but there aren't many new deals in Australia. There are a hell of a lot of new deals in the US market, in the Euro market, and in the UK and other jurisdictions. So if you're limited just to Aussie credit, the ability to invest money in really cheap, mispriced new issues, much like you might have an appetite for cheap IPOs, the Guzman and Gomez's on the equity market, the ability to do that just in Australia is very, very limited because we don't have many new issues. But the global market's 29 trillion, and so that global opportunity set is massive, and our ability to generate alpha is huge in those markets. We get it right about 80 to 90% of the time, and that's why, James, we have a global team. I have 5 traders in London, 5 analysts in London, and we're about to open up a trading pod in Miami.
Well, talk to us about your global strategy, the Coolabah Active Global Bond Fund. What's the objective? How's it different from the other strategy we talked about earlier?
So the Active Composite Bond Fund is benchmarked against a local index, the Composite Bond Index, and that's a 5-year duration index, as we discussed. The Coolabah Active Global Bond Fund is benchmarked against the global version of that index. That index is called the Global Aggregate Corporate Index, and rather than 5 years duration, it has 6 years duration. And in the Coolabah Active Global Bond Fund, we're targeting an excess return of 1 to 2% per annum above that index. And now we run this strategy for offshore investors. After retail fees, we beat that index by about 220 basis points or 2.2% hedge back to Aussie dollars in the last 12 months. So we've had very good returns in that strategy. It's longer duration, so 6 years rather than 5 years. It's also going to be more globally diversified. So the Active Composite Bond Fund inherently will have a stronger local Australian focus, and the Active Composite Bond Fund will hold more government bonds in addition to bank, insurer and corporate bonds. The Coolabah Active Global Bond Fund can invest in sub-sovereign agencies, but is really going to be focused on global bank, insurer, and corporate bonds. It's going to have many more names. Literally, the total exposure will be over 2,800 different names. Our active portfolio will be 100 to 200 positions typically, but we'll have some beta in the portfolio that will give you exposure to 2,800 global names. And that strategy is targeting a very similar volatility or return variation to the index, so similar risk to the index, but we're targeting 1 to 2% above the index. Last 12 months after fees, we've done 2.2% above the index in Aussie dollars. And for investors locally that want to start averaging into duration, particularly if we do get a pop-up in yields post the US election, you probably want to think about both those solutions because one's an Aussie solution, the other's a global solution. I just also mentioned that we did recently win a $1.1 billion US mandate from a global investor for the global strategy, given our performance in that space.
Can you explain hedging and why both these strategies are offered as hedge strategies?
Yeah, so Aussie dollar investors don't want to take FX risk necessarily. And so we offer Aussie dollar hedged versions of these strategies, but we do have other currencies available. So if you really want to access a US dollar version of the strategy, we can provide that access. In fact, we have New Zealand dollar, US dollar, euro, sterling, and Aussie dollar solutions available. But the main products here in Australia are Aussie dollar unit classes because most folks want to kind of strip out the FX risk.
Where do people get more information? How can they access the strategies?
The Active Composite Bond Fund can be accessed via platforms or as an ETF. The ticker is FIXD on the CBO exchange. You can also read a lot and access the online application forms via our website, coolabahcapital.com. You can also find out about the new Coolabah Active Global Bond Fund. That's a 6-year duration fund, which is not yet an ETF, but will be via the website. Obviously, we attach the usual disclaimer, past performance is no guide to future returns, and you should read the PDS to better understand the risks, and please speak to an advisor.
Well, ladies and gentlemen, I hope you enjoyed a few insights from Chris, getting his views on what's happening in global economies and the implications for fixed income markets. As mentioned, some information about a couple of the Coolabah Capital strategies as well. Thanks so much for tuning in.